Hey, Dan Passarelli here. Well, here we are. I'm shooting this just a little bit before the close, and pretty surprisingly, the market is up at this point, about 0.2%. And I say surprisingly because we're at this point going into the close still without a deal on this shutdown. The market was down earlier. I suspect that it is overzealous retail traders buying into the close here. They're sure not buying up a lot of options. The implied volatility is not that high, but there is a fair amount of smart money buying the crap out of gold and, well, not silver today. They've been buying silver lately, but especially gold today, which of course is a hedge against financial troubles. All that being said, this is also the end of the quarter, in which we tend to see some pretty unexpected moves sometimes. And that tends to happen as a result of options traders who have index options expiring and they've got to hedge their options long or short. And sometimes that pushes the stock around. And then on Monday, or not Monday, but on tomorrow morning, we tend to see all that stuff offset and the market goes back to normal pricing. Now, speaking of ETFs, I also want to talk today about a little tip. A lot of times people ask me, Dan, is there a difference between trading options on ETFs and options on individual stocks? And the answer is, well, yes and no. Let's start with the no. Options are options, right? I mean, if you understand how calls work and call spreads and put spreads, if you understand how that works with a stock, you understand how it works with an option and with an index and with a commodity, et cetera, et cetera, et cetera. So in that regard, it doesn't really work that much differently. In another regard, with ETFs, they are mostly American exercise style as opposed to indexes, which are often European exercise style. So they still settle the same. The main difference is volatility, because maybe one of the first things you ever learned about investing is that diversification leads to lower overall volatility. So when we have an index, like for example, the S&P 500, that has 500 stocks in it, even though 30% of that is really made up of the movements of the Magnificent Seven, 70% still isn't. It's still a basket. And so the S&P 500 moves less than a typical stock just because it's so diversified. Now that shows up in your option trading in a couple of ways. First of all, the implied volatility of a broad-based index ETF is going to be lower than a typical stock, than an average stock. Lower than the components of their basket straight averaged. Next, the historical volatility will also be lower, which by nature is how they work, right? If they move less, their historical volatility is less. So basically, when we're doing things like selling options, we're selling them for less cost because the implied volatility is lower, but there's less risk of the short strike being violated because historical volatility is lower. So one is not necessarily better or worse than the other. It's just a little bit of a different game. I hope that helps. This is Dan Passarelli, Trade Smart.